Welcome to Market Brief After Hours. It has been a fascinating and highly volatile week in the global financial markets. We saw some dramatic swings on Friday, capped off by some very hawkish commentary from Federal Reserve Chairman Kevin Warsh at the Jackson Hole Economic Symposium. Let's start with the big picture in the U.S. On Friday, we saw all three major indices take a hit, yet they still managed to secure a winning week. Can you walk us through those final numbers and what drove that Friday sell-off?
It was definitely a tug-of-war week. On Friday, the S&P 500 fell by 0.25%, closing at 7,712. The tech-heavy Nasdaq composite took a larger hit, sliding 0.52% to finish at 26,402, largely dragged down by weakness in semiconductor stocks like Nvidia and Intel. The Dow Jones Industrial Average managed to escape relatively unscathed, down just 9 points, or 0.02%, to close at 53,560. But despite that Friday dip, the weekly performance was positive across the board. The S&P 500 advanced 0.5% over the week, the Nasdaq gained 0.9%, and the Dow climbed 0.5%, marking its first winning week in 3.
That's a resilient showing for the week as a whole, but Friday clearly belonged to the bears. What exactly did Kevin Warsh say at Jackson Hole that spooked investors so much?
It really came down to his tone on inflation. Even though we've seen some softer inflation data recently, Warsh made it clear that the Fed is not ready to declare victory. He noted that while this summer's PCE and CPI readings were better than expected, they don't convince him that underlying trends have meaningfully improved. He emphasized that the Fed must be confident that underlying inflation is moving towards its objective clearly and at sufficient speed. His exact words were, "Otherwise, we have work to do. That's our job, our mandate, and our charge to keep."
That is incredibly direct. It sounds like he's keeping a rate hike very much on the table for September. How did the bond markets and futures traders react to that?
The reaction was almost instantaneous. Bets among Fed funds futures traders for a rate hike in September surged to about 57% on Friday, up from just 35.4% a day prior. Over in the bond market, we saw a massive move in short-term yields, which are highly sensitive to monetary policy expectations. The 2-year Treasury yield jumped more than 12 basis points to end at 4.356%. Meanwhile, longer-term yields were relatively flat, with the 10-year yield up about 5 basis points to 4.726% and the 30-year bond yield ticking up 2 basis points to 5.211%. It's clear that the market is repricing the Fed's path, interpreting this as a very strong signal that the central bank is looking for internal consensus to tighten policy further.
It feels like the era of easy money is being pushed even further into the rearview mirror. Let's shift our gaze across the Atlantic. How did European markets handle this hawkish tone, especially considering their own economic challenges?
Surprisingly, European stocks managed to close higher on Friday, showing some resilience. The Pan-European Stoxx 600 climbed 0.51%. Looking at individual countries, the UK's FTSE 100 gained 0.29%, and France's CAC 40 moved up 0.98%. Germany's DAX was a standout, rising 0.77% to hit a new closing high, while Switzerland's SMI edged up 0.11%.
That's interesting. What was driving that optimism in Europe, given the global rate worries?
It was a mix of domestic economic data and corporate earnings. In Germany, the seasonally adjusted unemployment rate held steady at 6.4% in August. While that is still its highest level since 2020, the rise in the number of unemployed was slightly smaller than expected. However, inflation concerns are still lingering there. Germany's import price inflation accelerated to 6.8% on a yearly basis in July, driven by rising energy and intermediate goods prices, which have been exacerbated by tensions in the Middle East.
And what about the broader euro area? Are consumers feeling any more optimistic?
There is a slight glimmer of hope. Consumer confidence in the euro area edged up to minus 15.5 in August, marking the 4th consecutive monthly improvement. But on the growth front, the picture is still mixed. In France, the preliminary estimate for inflation rose to 2.7% in August, up from 2.4% in July. At the same time, France's economy stagnated in the second quarter, missing preliminary growth estimates. Down in southern Europe, Italy saw its industrial turnover drop 1.0% in June, and Spain's inflation hit a more than 3-year high of 4.3% in July, driven largely by energy costs. So while European stocks had a good day, the underlying macroeconomic landscape remains quite fragile.
Absolutely. A real mixed bag of inflation and sluggish growth. Now, let's head over to Asia. How did those markets perform on Friday?
Asian shares were mixed as investors weighed geopolitical risks, specifically looking for clarity on whether talks between Iran and Qatar might open the crucial Strait of Hormuz to ease oil supply disruptions. In China, the Shanghai Composite fell 0.11% to 3,952, weighed down by power equipment stocks after a new U.S. order targeted certain foreign-made power equipment. Hong Kong's Hang Seng Index was highly volatile but managed to finish marginally higher at 25,585.
What about Japan and South Korea? They've been major focal points lately, especially with the tech sector.
Japan had a solid session. The Nikkei average edged up 0.41%, and the broader Topix index rose 0.72%, led by tech and chip stocks tracking their U.S. peers. Tokyo's core inflation data, which is a leading indicator for the country, rose to 1.8% in August, suggesting nationwide inflation is holding steady around 1.7%. South Korea, however, was a completely different story. The KOSPI index plunged 1.79% on fears that Washington is considering new tariffs on imported semiconductors. That sent shockwaves through their tech giants, with Samsung Electronics falling 3.4% and SK Hynix plummeting 4.4%. Down under, Australia's ASX 200 gained 0.60%, while New Zealand's NZX 50 fell 0.81%.
We're going to take a very quick break. Stay with us. Welcome back to Market Brief After Hours. Let's pivot to the currency markets now. We saw some significant technical breakdowns and breakouts on Friday following that Jackson Hole speech. Let's start with the euro and US dollar pair. What happened there?
The Euro-USD pair experienced a major bearish reversal. It closed down 0.56% at 1.1587. What's technically significant here is that the session produced a strong bearish candle that sliced right through the key 200-day simple moving average, which was sitting at 1.1631. This shows that sellers have taken decisive control. The pair is now testing its 100-day simple moving average at 1.1573. If it fails to hold there, we could see a deeper correction down toward the 50-day moving average near 1.1487.
That is a significant technical shift. Did we see a similar story with the British pound?
The pound also retreated, but its medium-term structure looks much healthier. GBP USD closed down 0.40% at 1.3539. While we are seeing some profit-taking after recent highs, the pair remains comfortably above its key moving averages. The 100-day is at 1.3443, the 200-day is at 1.3435, and the 50-day is at 1.3424. So while there is short-term downward momentum, the broader uptrend that started back in July is still technically intact unless we break below the 1.3500 psychological level.
Okay, so the pound is holding up a bit better. What about the US dollar against the Japanese yen and the Canadian dollar?
The dollar showed strength in both pairs. USD JPY rose 0.43% to close at 160.08, successfully pushing back above its 100-day simple moving average of 159.97. It's now sandwiched between that level and the 50-day average at 160.84, but well above the 200-day baseline at 158.40, indicating a steady recovery. As for the Canadian dollar, USD CAD advanced 0.33% to close at 139.00. It found strong support at its 200-day moving average of 13843 and is now testing its 100-day average at 13914. This move up happened despite Canada reporting a very strong annualized GDP growth rate of 3.3% for the second quarter.
It seems the US dollar is reclaiming its throne as rate hike expectations rise. Now, that brings us to commodities, which had an absolutely wild day. Gold and silver got hammered, while agricultural commodities surged. Let's start with the precious metals.
Yes, gold suffered a massive rejection. It plunged 3.07% to close at $4,461. The session produced a massive bearish engulfing candle, wiping out days of gains and slicing below the 200-day moving average of 4,516. We are now looking at support near the 100-day moving average at 4,387. Silver was hit even harder, falling 4.00% to close at $66.47, rejecting sharply after failing to clear its 200-day moving average at $71.47.
This aggressive selling shows that the rising yields and strong dollar are putting severe pressure on precious metals.
On the flip side, we saw grain prices skyrocketing. What is driving that?
It's a supply shock story. Wheat and corn hit more than 3-year highs, and soybeans reached their highest level since early 2024. Wheat touched $7.72 per bushel, up 10% for the week and a staggering 51% this year. Corn reached $5.41 per bushel. This is largely due to escalating military attacks by Russia and Ukraine in the Black Sea, which have halted almost all grain shipments through critical ports. Poor summer weather in the U.S. and strong Chinese demand are also adding fuel to the fire. This is going to keep food inflation concerns very high.
That is a major concern for global inflation. Let's wrap things up with individual stock movers and cryptocurrencies. We saw some massive double-digit moves on Friday. Let's start with PayPal.
PayPal was one of the biggest stories of the day, with shares plunging 12%. This came after reports that buyout firm Advent and payment processor Stripe decided not to pursue a deal to acquire PayPal, which would have been one of the largest leveraged buyouts in history.
A massive blow for PayPal investors. What about Marvell Technology and Nvidia?
Marvell Technology dropped 10% after its current quarter guidance for gross margins disappointed Wall Street, even though their earnings per share outlook was slightly ahead of estimates. Nvidia also fell over 4%, leading the decliners in the tech space. On the positive side, we had some massive earnings winners. Elastic NV surged over 19% after beating earnings expectations and raising its full-year guidance. Retailer Gap also jumped over 13% after raising its earnings forecast and appointing a new chief executive for its Old Navy brand.
And finally, how did the cryptocurrency market react to the Fed's hawkish tone?
It was a sea of red. Bitcoin dropped 3.14%, falling below the key $78,000 mark to trade around $77,473. Ethereum fell 2.84% to $2,433, and Solana slid over 5%. Crypto-exposed stocks like Coinbase also felt the pain, dropping 7%. Historically, September has been a tough month for Bitcoin, so traders are definitely showing some caution here.
That brings us to the end of today's episode. Just a quick reminder for our listeners, because Monday is a bank holiday in the UK, we will be taking a brief pause and will return with our next update on Tuesday. If you find this useful, please follow Market Brief After Hours on your favorite podcast platform. Thank you for listening and have a wonderful weekend.